Good morning, guys. Another beautiful day. And today I wanted to talk about something that I believe many new traders in the market fail to understand, which is called printing the tape. And so, first, let me say, let's talk about what it means, where it came from, the history behind it, how it works in the current markets, and what can you do to protect yourself against such manipulation in the market. And so, basically, before this online electronic financial trading was available, most of the trading was done through looking at the tape. So every good investor, at least every good trader, they had a ticker tape equipment which would print the stock prices on a minute by minute or on a time by time unit basis. It could be minute by minute, hour by hour. And so that's how people used to trade. They had a tape printing machine, and the tape would be basically printing the prices of the stocks as the price fluctuated through the day. And what people would do, especially when the market wasn't that liquid, and I'll just give you a simple example to make it clear, which is basically this was in the Roaring Twenties in USA in the Wall Street. So after the First World War, all these new players got into the trading market in Wall Street. And the way they made money was basically by printing the tape red or printing the tape green. So basically, what they did was they'll identify times of the day when the volume of trade is the lowest. And at those times of the day, they'll target some stocks and they'll do small volume trades. And the trades, the intention behind those trades would be to manipulate the price rather than to actually trade and make money. So basically, how this works is, let's say the trader identified that at 1 p.m., the volume of trade in a particular stock was the lowest at any time of the day. Okay, cool. And so that's the time they would target. And so let's say that stock is on average trading around 200 shares every hour. The average number of trades for that stock is 200 shares. But this trader identified that at 1 p.m., only 10, 15 shares of that stock were traded. And so what they'll do is get into the market at 1 p.m. And let's say the stock price right now is at $40. And it's going to, the fundamentals and everything says that the price is going to go up, most likely. And so they'll get into the market at 1 p.m. when the stock volume trade is the lowest. And it will be usually involving two or more traders who will collude on this objective, and they'll basically beat the price down. Okay, so they'll get into the market at 1 p.m. The volume of trade of the stocks at 1 p.m. is the lowest, around 10 or 20 shares per hour, and they'll basically do 10 shares or 5 shares of trade in that hour at a low price. Though if the stock price is at 40, they'll trade with each other for 38, 35, 30. And so what as a trader outside the market, what you are looking at the tape or at the price, you're looking at 1 p.m. The stock price went down from $40 to 35, 34 to 30. Okay. But that's not a real representation of what's happening in the market, because this bunch of traders are colluding to bring the price down, and they found this hour in the day where the volume of trade is the lowest, where their volume of trade will have the most significant effect on the price of the stock, because the total volume of trade of that stock in that hour is the lowest, and they're basically bidding the price down so that other market participants will panic and start selling their shares, which will cause a further downfall of the price. And then the initial traders who colluded on this, they'll just buy up the stock at a cheap price. And eventually they'll make money because the fundamentals of the stock were strong. But to the external traders, the other traders, they're looking at the tape, they're seeing the price go down, they're panicking. They're not understanding that this bunch of traders are colluding to print the tape red. And so they're panicking and they're selling. And basically, this is how some traders manipulate the market by getting in at times of low volume, manipulating the price, and then basically manipulating the market sentiment and basically kind of pushing other people to go their direction so that they can buy the stock cheaply. And yeah, that's basically what they do. I mean, there's laws against it right now. I mean, yeah, back then there wasn't many laws against this market manipulation, and there are many laws against it now. But even then, like if you're colluding with another trader and you guys have no particular relationship that's in public information, you can still trade with him, bid the price down, and as a market regulator, it'd be hard to identify whether you guys are colluding, right? So there are laws against that in the books right now, but it's still possible to do and still possible to do and get away with. And so I think the fundamental lesson to take away from this is that when you're looking at price fluctuation in any financial instrument, let's say stock in this case, and you're seeing significant price change, the first thing you should look at is the volume. Okay. If the volume of trade is much lower than the average volume of trade of that financial instrument on a day-to-day basis, then you should not panic and go with the market price flow. In that scenario, it would be better for you to hold on and see how it works out, right? And especially if you're looking at the books of the stock and the fundamentals say otherwise. And yeah, that's a very common phenomenon that a lot of new traders fail to grasp. And it happens in other markets too. Like, for example, let's talk about the oil markets. So during COVID, the volume of trade in the oil markets went down because there wasn't a lot of demand for energy. The demand for energy collapsed all of a sudden because people went back to their homes, started working from home, and they stopped using the transportation. And so the oil market became very illiquid. And so another way to phrase a time when there's a low volume of trade in a particular financial instrument is to say that that financial instrument is illiquid. There's not a lot of liquidity in the market at that moment. And illiquid markets are the worst. Okay, they're the most dangerous markets. You shouldn't trade in an illiquid market. You should try to avoid that as much as possible. And so, for example, what happened in 2020? Well, the oil market became illiquid. There wasn't a lot of trades because there wasn't a lot of demand for oil. And so you ended up with basically big players like Russia and Saudi. They saw this as a perfect opportunity to destroy you the expensive fracking and oil sands industry of North America. Okay, so they could do a few trades at a loss at low volume and bid the oil price down all the way it went to negative oil. And yes, they lost a bit of money on the trade, but overall, the oil market collapsed and they made money by increasing the market share by destroying the expensive fracking and oil sands industry of North America. And so I think this is a this is something that basically a lot of new traders fail to understand, which is that you have to first look at how liquid the market is. And one way is to look at the volume of trade, another is the spread. And so the spread is basically the difference between the bid and offer. What are the bids at what prices are the market participants, the traders willing to buy that instrument, financial instrument, and it offers the price at which the traders are willing to sell that financial instrument. And so this is the bid and offer, and the difference between the bid and offer is the spread. And in theory, at least in a very liquid market, the spread would be minimal, almost zero, barely anything. And so if you buy an instrument, financial instrument now, you can instantly sell it and occur very little transaction cost, which is basically the difference between buying and selling price, right? And so if you see the spread increasing and the spread is very big, that's a very illiquid market. And yeah, my personal um, suggestion is to basically stay away from illiquid and low volume trade markets and markets with a high spread, even if you're confident in the direction the financial instrument is going, because other traders can manipulate the market, and even if you don't want to fall for the trap, there will be other traders who will fall for the trap and crush the prices, or move the prices against the direction you're betting on. And so that's what you have to understand. You can't be like, oh, I'm confident the fundamentals of this financial instrument indicate the price will go this way, up or down. I'm confident about that. I don't care if the other traders manipulate the market. I don't care what happens. I think that's a big mistake, because at the end of the day, trade price is determined by the traders buying and selling. It's not determined by the fundamentals. The fundamentals are a signal, no doubt, but the price is determined by the traders, by the buyers and the sellers. It's not determined by what's going on in the balance sheet. Okay, that doesn't set the price. The price is set. I mean, in a fair world, that's what would set the price, but in reality, the price is set by the buyers and the sellers. So this is a very important concept that you should understand. And you should always avoid trading in illiquid, low volume, high spread markets as much as possible. And yeah, what's another good example? I mean, like right now, the markets are, and so like when we talk about liquidity in the market, okay, people, I'll just, connect another concept with that, which is sort of related. There's not high correlation, but there's definitely some level of logic behind that, which is that, and so when is a financial market very liquid? When do a lot of volume of trades occur in a financial market? At what times and under what conditions, right? That's the big question. And people try to connect the interest rate basically, which is not a bad connection, right? Because when the rate at which you borrow money, your cost of borrowing money, when that interest rate is high, the cost of borrowing money is high. Okay, the markets, other financial markets, stock market, oil market, whatever, other markets become very illiquid. And the reason is because, well, twofold. One is because you're getting a higher return, risk-free return by investing in that high interest rate bond. So money moves out of the risky financial markets and into the bond market. That's one reason. And then there are the risk takers, the hedge funds, the big guys who basically borrow money to trade in the risky financial markets like the stock market and all that. And even they will borrow less money because the cost of borrowing the money is now high, right? And so at times when the interest rates are high from the central banks, the other financial markets become very illiquid for those two reasons. And so I know, yeah, the interest rates are coming down in most Western countries. How fast that will happen, that's a matter, we'll see. But I mean, Canada, for example, they're dropping the interest rates fast. They've realized the economy is very weak and it can't handle this high interest rate environment. So yeah, you'll see more liquidity coming into the Canadian stock market, commodities market. And whether it's a good thing or bad thing, we'll see. But definitely more liquidity will come into the Canadian stock and commodities market. USA, I think, will just hold the line for a bit more in terms of dropping the interest rates any further. Just because I'm not saying Jerome Powell doesn't like Trump, but clearly they have friction. But even that's not the problem. I think Jerome Powell understands the fundamental flaw. I mean, the only thing that I think will push Jerome Powell to drop interest rates at a faster pace than what they're doing right now is the crash of the commercial real estate market. But even then, I don't think Jerome Powell will have the political motivation to do it. I know he's not a political person, but let's be honest, they're not independent as they claim to be. And yeah, there's a lot of backdoor deals that happen. And I think what will happen is basically the rates in USA will stay high for at least until the commercial real estate market crashes next year, which I predicted, which I'm pretty sure will happen. And then they might be willing to drop it a bit more. But yeah, we'll see. But the problem with this kind of like the now we're going back to the fiat currency and you know flooding the market with new economy, all that concept, and these are all connected. So the problem is when you so if you can think of financial markets as a swimming pool full of water, okay? When you take water out of the swimming pool, it gets more difficult to swim. It gets more difficult to float in the pool and swim. And when you flood the pool with more water, it gets easier to float and swim in the swimming pool. But if there are leaks in the swimming pool, right? If there's a burst in the swimming pool and water flows out, like any financial bubble burst in the financial markets, then you have to basically flood the swimming pool with more water because otherwise you have a swimming pool, there's a burst and water is flowing out, and at the same time, by keeping interest rates high, you're sucking the water out of the swimming pool, and so the it's getting more and more difficult to swim in the pool, and so you have to drop the interest rates, and I mean that means flooding the swimming pool with more water. And the problem with that is with every burst in the swimming pool, you have to flood the swimming pool with a bigger quantity of water, if that makes sense. And the problem with that is you have to increase the circulation of US dollars in the economy by a bigger amount than you did in the previous crash, in the previous burst, if that makes sense, right? Um, so yeah, if you look at federal balance sheet after every financial crash, you'll see what I mean. And so yeah, the federal balance sheet is like this. They have the assets, they have the liabilities, and they're going like this. And then there's a crash. They have to flood the market with more circulation of money, and the balance sheet expands. And then there's another crash, and the balance sheet expands again. And yeah, so the problem with this kind of fiat currency that's not backed by gold is that every time there's a financial crash, you are basically forced to flood the market with more circulation, more stimulus than you did in the previous crash. So yeah, just to give you a context, for example, in the 2008 financial crisis, uh, I think the U.S. Federal Reserve flooded the market with close to $1 trillion. And then during the COVID financial crisis, they flooded the market with, I believe, $5 trillion, something like that. And so if there's another financial crisis next year, they'll have to flood the market with at least something higher than 5 trillion, could be 10. And so every time there's a crisis, you have to flood the market with money, and not just money, not just new money, but money in a quantity higher than you did in the previous crash, if that makes sense. And the problem with that is the bigger, at one point, it becomes a mess that's hard to control, right? And it becomes such a big pool of money, big circulation of money that your interest rates decisions and your policy decisions have little more and more little effects going forward. And yeah, so I just want to talk about this concept of printing the tape. And yes, now I mean depends how the interest rates pan out in the next few months, but I believe that if the interest rates stay high enough, this printing the tape red will be a phenomenon you have to watch out for, especially in US stock markets. But yeah, if the interest rates drop, and I guess you can avoid it. But again, like just be aware of the fact that you should not trade around times of low volume of trade. That's just the fundamental concept, okay? So yeah, that's it from me for this video, and yeah, I'll come back with another one.